All right, let's get right into it. Gold has just been on its biggest rally in decades. And trust me, this is not just some minor blip on the chart. What we're seeing is a fundamental shift in how the entire world thinks about money, risk, and, what's actually safe. Today, we're going to break down this insane price surge, really dig into the powerful forces behind it, and then take a look at what the world's biggest banks think is coming next.
First off, just to get a sense of the sheer scale of this move, look at this number. Gold hit a shocking intraday record of over $4,381 an ounce back in October 2025. This isn't just a new high, it's a completely different price reality for an asset that for the longest time was supposed to be, well, stable.
And what's really wild here is the timeline. The price has literally more than doubled in just 2 years. We went from around $2,000 an ounce to consistently trading above $4,000. Now, for an asset that's supposed to be the boring insurance policy in your portfolio, a 100% return in 24 months is anything but normal. It's not supposed to act like some high-flying tech stock.
So that brings us to the big question. Why is this happening? Because this rally, it goes way beyond the simple explanations, like inflation or temporary fear. Something much deeper has changed in the global financial system. So why is gold suddenly acting less like an insurance policy and more like a massive momentum trade? Well, the answer seems to lie in 5 incredibly powerful forces that are all pushing in the exact same direction. And the key word here is that these are structural changes, not just temporary cyclical trends. And that is what makes this rally so fundamentally different from anything we've seen in the past. Let's break them down. The first, and you could argue the most powerful driver, is the completely unprecedented level of buying from the world's central banks. We're talking about sovereign nations gobbling up physical gold at a pace we have not seen in over 50 years. And this quote just lays it out perfectly. A 2025 survey from the World Gold Council found that a massive 76% of central banks plan to increase their gold holdings. Now think about that. This isn't speculation. This is a deliberate, long-term institutional reallocation. They are not trying to time the market. They are permanently repricing risk right onto their balance sheets. Okay, on to the second force, de-dollarization. Look, this isn't some conspiracy theory anymore. It's just practical risk management. In a world of sanctions and asset freezes, nations are waking up to the fact that holding another country's currency comes with some serious political risk. Gold is the only major reserve asset that isn't someone else's liability. It exists outside of any single nation's control, which means it can't be frozen or devalued by another country's policies. Now, the third driver is the whole relationship between real interest rates and the dollar. For years, the rule was super simple. Higher rates are bad for gold. But that link, it's gotten a lot weaker. Now, even with higher rates, the opportunity cost of holding a non-yielding asset like gold seems pretty small compared to the risk of, say, your currency being debased or some geopolitical mess. The fourth force is that geopolitical risk. Well, it's not a temporary shock anymore. The market is now pricing it in as a permanent, structural feature of our world. Constant conflict, trade wars, instability, it's all created this persistent demand for a truly neutral safe haven. And finally, the fifth driver, financial demand follows the smart money. When professional investors see the world's central banks buying tons and tons of physical gold, it sends a powerful signal. And that kicks off this reinforcing loop, right? ETFs, funds, and individual investors all pile in, which just amplifies that initial move. So you've got these 5 powerful structural forces all pushing gold higher at the same time. But what does all of this convergence actually mean for the global financial system? What is the market really trying to tell us here? What it means is that this rally isn't a bubble. It's a fundamental global repricing of systemic risk. Gold has basically become a thermometer, and right now it's measuring the temperature of some very, very deep-seated fears about the future of the entire financial order. And specifically, it's measuring 3 modern fears. First, the political risk that your assets, even your sovereign reserves, could be seized or frozen at a moment's notice. Second, the growing fragility of government debt and the very real risk of currency debasement as deficits just soar. And third, a general, nagging distrust in the stability of the entire global financial system itself. And when all those fears come together, gold doesn't just rise, it gets a whole new price tag. Okay, so that's the why. Now let's turn to the what's next. Let's take a look at what some of the world's largest and most influential financial institutions are forecasting for the price of gold as we head into 2026.
The consensus among the big players is pretty clearly bullish.
You've got JP Morgan calling for $5,000 an ounce, Morgan Stanley targeting around $4,800, and even the more conservative Goldman Sachs sees gold holding strong at $4,000. The general feeling is that this rally definitely has more room to run, even if it's maybe at a bit of a slower pace.
So let's translate these forecasts into a few possible scenarios. The first one, and probably the most likely, is what you'd call an orderly bullish rally. In this world, central banks just keep on buying. The dollar drifts a little weaker, and gold kind of consolidates before pushing up towards that $4,300 to $5,000 range. This is the base case for most analysts.
Scenario 2 is more of a volatile, sideways market. This is what could happen if geopolitical tensions were to ease up in a big way, or if real interest rates were to rise sharply, making gold less attractive. In that case, the price would probably just chop around in a wide range without making a decisive new high.
And then you have the third scenario, the tail risk breakout. This would get triggered by a major unexpected crisis. A sovereign debt problem, a massive escalation in a conflict, something that sends investors scrambling for true safety. In that kind of outcome, gold could absolutely blow past $5,000, shifting from just being an asset to becoming a true monetary refuge.
So, with those scenarios in mind, how can you track where we're heading yourself? Let's finish up with a quick toolkit, the 6 most important indicators to keep an eye on to really understand gold's next move.
First, keep a very close watch on central bank net purchases. As long as they're buying, the price has a really strong floor under it. Next, look at U.S. real interest rates. Generally, lower is better for gold. The dollar index, or the DXY, is also critical. A weaker dollar is usually a tailwind. You'll also want to watch the flows into gold ETFs. That's a great gauge of broader investor sentiment. Of course, any major geopolitical event, especially ones involving asset freezes, that's going to boost gold's appeal. And finally, don't forget about physical demand from huge consumers like India and China. That provides a whole other pillar of support. So the bottom line is this: gold's massive rally isn't just some bubble. It's a fundamental repricing of systemic risk, as gold reemerges as a core monetary asset in a world that feels like it's fracturing. And all of this really just leaves us with one profound question to think about. Has gold stopped being just a hedge and started becoming money once again?